Hi, everybody, and welcome to the start of my new first-time buyer playlist. My name is Ben Casper. I've been doing residential mortgages for families since 2017. I work for Movement Mortgage now, and I've done hundreds of these transactions for people, purchases and refinances, and in over 20 states. This quick video series is just going to show you a simple way to get a mortgage, get you some confidence, and teach you everything I'd pretty much want to know if I didn't know any of this stuff myself. So thank you for following me, watching, and letting me be your guy. Just take some notes if you want, and then save your questions to discuss offline. Also, please subscribe and share this with your friends and your agent. Okay, so to start, we're going to lead with qualifying. All right, so to qualify for a home, you got to qualify in mainly three things. That's 1, your credit, 2, your income, and 3, your savings. We're going to cover each of these three further later, but for now, just a quick synopsis. For credit, you usually need a credit score of at least 580 or 620, and then have at least some history of some car, credit card, maybe student loan history. And then for income, they want to make sure that you have enough income coming in to satisfy your minimum payments. So to calculate that, we add the minimum monthly payments you got to make on all your car, credit card, student loans, and other homes you have, and that has to be less than 50% of your gross monthly qualified income. So that then percentage is called your debt to income ratio. That debt to income ratio has to be usually within 50%, somewhere around that. And then third, your money you have saved up has to cover your down payment, if you have one, and any closing costs and prepaids, that if those are also required on your loan. So that's the three. Okay, so how to apply and when? The time to apply is when you're actually serious about going out to look for homes. It is not after you put your pants on and go find a house you've seen and then you want to apply for it. If you do it that way, it might be too late. There might be too many things that may have to happen for you to actually qualify in time to make an offer. Now, you might be able to do it that way, but you also may need a little bit more work, need some research and underwriting assistance. Also, your agent likely won't want to take you to see a house if you're not pre-qualified. If they think there's a chance you might not qualify for the home, they don't want to waste your time or both. So to do this, you just call me. I collect your information over the phone, or I can send you a link to apply. It'll take 7 to 15 minutes over the phone, usually, or 20 minutes, 25 minutes online. And I mainly just need to know two things. How much you make and how much you have saved. And then, that's all off the top of your head. And then I'm going to want to see your pay stubs as well after that. So the pre-qualification or the pre-approval letter, as it's also called, they're both the same thing, really. They're two terms used interchangeably. This is absolutely needed for your offer. Sellers will not take a bid from you without this verified letter from a lender. So what happens is we gather all that information you gave us in the application. We send it to the servers or the automatic underwriting system, the decision engine at Fannie Mae and Freddie Mac in DC, and their servers are going to give us an approval based on your credit score, your official liabilities and debts, and just a verbal of your savings and income. Now, I'm going to verify your income and savings before you make an offer on a home so that nothing bad happens, but that's the importance of the pre-qual letter. Now, one of the most frequently asked questions by buyers at this point is, do I really need my credit pulled? And the answer is yes, because we absolutely need to see, 1, your credit score, and 2, calculate your debt to income ratio, because that credit report is going to give us the minimum monthly payments you have on all your current debts outstanding. This is not necessarily going to impact your credit score. It could if you're wildly checking your credit over the last 12 months. Like if you've checked it 5, 6, 7 times, and there's a decent chance it'll affect that. But how many times you check your credit is a much smaller factor in determining your credit score than all the other factors that determine your credit, which we'll cover later. And I just also want to cover who Fannie Mae and Freddie Mac are. They are the 2 largest homeowner agencies in the country. They are basically created to help Americans attain financing at the lowest rates possible. Now, most all the guidelines, the rules, the product that we're giving it mostly comes from them. And it's almost as if mortgage companies like mine are somewhat almost middlemen of them. Just like Walmart selling Oreos, they don't make them there directly. So the alternative to Fannie Mae and Freddie Mac, if you don't like this underwriting and all these rules, well, you can go find what's called a hard money lender out there who can charge you an interest rate that could be 3 to 5% higher or more and could charge double or more in closing costs. So you don't want to do that.